So today we will do a small intro ahead of our 1 hour Teams presentation on Thursday at 2 o'clock Swedish time called Are We in a New Bull Market? Where we will discuss the current setup in markets with senior economist Harry Colvin from Longview Economics. I'll discuss with Harry today a few of the subjects that we will touch upon on Thursday. So very welcome to this. Hi, Harry.
Hey, Stefan, how you doing?
I'm good. How are you? Sorry for being late.
No, don't worry. No worries at all. Have you had a good
Interesting
weekend?
update on oil this morning.
Oh, good.
Yeah.
Shale stuff's fascinating, isn't it? I've always found it very interesting. It's so important.
Yes, it is. It's that marginal change, right?
Yeah, it's all about, it's the marginal driver, isn't it? Yeah.
Yeah, I remember I was working at Citigroup. This is like in 2011 or something.
Yeah.
And they made a big piece with a guy called Ed Moore. You know him?
Well. Yeah, he's well known, yeah.
Yeah, and he had this thesis that US would be energy self-sufficient in a decade or something. And it went that way, so.
Yeah.
That was dramatic at the time.
Well, yeah, and I think he's currently quite bearish, isn't he, on oil?
Yeah.
Yeah, he's quite good.
Yeah, that's good. So you and Brad had a massively good call on oil price.
Yeah, that's been a good call. Yeah, thank you. Yeah, it's never easy, is it? But yeah.
No, never easy. It's difficult. I mean, I'm very surprised if one were to describe the situation with that we currently have and where the stock market is. It's a bit puzzling.
Yeah, it's You mean equities at the moment? Yeah,
Equity, stock market. Yeah.
Yeah, it's bizarre, isn't it? It's like we're into a little bubble in AI and tech.
Yeah, and it's as you wrote in the Longview on Friday, the piece where liquidity is obviously still there. It's just it's in these 5 mega stocks that are. I mean, they're probably representing like 80-90% of the gains this year.
Yeah, exactly.
I read yesterday or 2 days ago that half of the Russell 3000 is down from the October lows. It's below the October lows. Half of the stocks in the R3K.
Yeah. It goes to show you, doesn't it, that actually markets are massively distorted, as you say, by a small handful of stocks.
Yeah.
And the rest of the market is quite worried about life.
Yeah, the rest of the market is in bear market territory, clearly.
Yeah.
It's just that the overall market is not.
Yeah, exactly.
In terms of value, that is, of course. So that's liquidity again, as you mentioned.
Yeah.
Right.
Yeah, I think what happens is we need to at some point probably recession will start. But these big cap stocks, and actually the rest of the market normally markets don't enter the sort of recession related bear phase for a month or 2 or maybe 3 before recession starts. So until we really get to the point where we're on the cusp of recession, these stocks can do anything, can't they? And you can see tech squeezing higher a little bit more, at least until we have until maybe there's more frothiness around and everyone starts getting very bullish about the economy and optimism starts getting to high levels.
Yeah, no, I fully agree. It's like it's the timing that is the issue. The direction is not so difficult. Yeah. But the timing, is it going to be Q1, Q2? I mean, I was expecting quite sharp downwards move in Q1. And we had this huge volatility, super strong January, disaster February, March was volatile, down and up.
Yeah. So timing is always challenging, isn't it? I mean, one of the indicators I like to look at is the yield curve, because usually once it's steepened up to about 50 basis points on 2s, 10s, then the recession is just about to begin. That's been the history of it, which is, basically the rates market pricing in a proper, the start of an easing cycle, basically. And we haven't got there yet, so we're probably not. It's probably not very imminent. Maybe it's a story for later in the year, or I don't know. We'll have to see how the data evolves.
What did you say about the yield curve there? The exact measure that you were looking at?
So if you look at 2s, 10s, part of the curve, normally recessions start in terms of the date of the start of the recession. They start once the yield curve is steepened up to about 50 basis points. And it's not every time, but most times it needs to steepen first before the recession begins. So if you want to think about how imminent the recession is, really you want to wait to see that steepening up first to sort of start, before you start to expect it.
And when you say that, because you mean the negative inversion?
Yeah.
Needs to be, because we've been way below 50 bips.
Yeah. And so I'm saying we need to go to positive 50 bips.
Positive 50 bips.
Yeah. So now we're inverted by about 50. Well, something like 50 to 100 bips, let's say.
75 or something, I think. Right now.
Yeah. So before recession begins, you would expect the curve to steepen, so the inversion to unwind, and for the curve to once again become upward sloping, no longer inverted, an upward sloping yield curve, because and that's driven by both lower 2s and lower 10s. But really, what's happening is 2s fall very, very sharply, more than 10s, so that you're then steep. And the driver, of course, of that much lower 2-year yield is the pricing in of much more significant cuts at the front end of the curve. So that, I think, will be an early sign that recession is pretty imminent when that happens.
Yeah. Okay, so what we've seen over the past couple of weeks, where the 2s have risen so sharply, that is suggesting that it's not that imminent then.
Well, yes, and of course, a lot of that is pricing out the risk of a default in the US, because we priced in a lot of cuts this year, because I think markets were worried about default, and then the Fed would have to ease probably on a default, and that risk has gone away. So yeah.
So pricing out the risk of default, that means that the 2s have risen.
Yeah.
And then we're gonna see more signs of economic downturn.
Yep.
And that is gonna argue, hopefully also, that inflation comes down, and that is expected for the second half. And that is gonna be argument for the Fed to start be more supporting.
Yeah, and I think we need to see not just low inflation, but we need to see some of the data getting, continuing to get worse, which I think we will. We're going to see much weaker credit growth in the second half of the year. So the credit cycle's turned, and it's going to really decelerate, and that will feed into the economic cycle. And that's when I think we start to see, the Fed loosening up. So we think credit is outstanding bank loans will be contracting by 10 to 20% by the end of the year. It's a really sharp fall in credit growth, because credit conditions are so tight. They're a very good leading indicator of credit.
Yeah. It'll be hard to see how the stock market can perform in that environment.
Yeah, well, it's going to be that I think that we're going to have some challenges then later in the year for equities. Yeah.
And what's your take on, the first quarter results in terms of earnings? They declined by less than feared, and we had some, the results from the most important stocks were overwhelmingly positive.
Yeah.
So the net impression, at least from my point of view, is that the earnings season were less bad than feared.
Yeah.
With strength in all the right places to support the market.
Yeah. Yeah. Well, I think it's one quarter of earnings. And
Yeah.
it is a bit better than expected, sure. But the trend in earnings is generally still poor. It's still shrinking.
Absolutely. And this is the second quarter with falling earnings, but isn't that earnings recession? 2 quarters in a row with declining earnings.
Yeah, I suppose you could think of it like that. But
because I heard other people saying that we're heading to an earnings recession, and then what is an earnings recession if it's not?
Yeah. Well, exactly, and the trend is down. I think earnings are clearly under pressure, and the way to think about it is inflation. From a macro perspective, the way to think about it is that inflation is falling quite quickly. Volumes are also starting to deteriorate. We think they're going to get worse. So, if you think about top level revenue growth, it's going to be proxied, it's going to be similar to nominal GDP growth, which is going to decelerate quite sharply. And wage inflation is coming down a little bit, but actually what's important is unit labor cost growth is still quite high, and it's not really coming down as quickly. So I think that's going to cause a squeeze on margins, and that's why we're going to see weaker earnings going forward. And particularly if we're right about credit shrinking, very hard to believe that earnings are going to keep growing if total bank lending is going to be shrinking by, say, 10 to 20%.
Yeah. No, that's a tough equation. Bank lending down 10 to 20%.
Yeah.
Nominal revenue growth weaker.
Yeah.
And salary inflation down, but not by enough to compensate. So margin squeeze from lower top line versus OpEx, and less investment, lower demand for services, basically, or for the corporate.
Yeah, and we've got house prices that are going to be that are going to slow more. So there's going to be some negative wealth effects coming through. Net household wealth is already shrinking year on year. That's going to get a lot worse, I think.
Yeah, the negative net wealth effect from lower house prices.
Yeah.
And that's going to impact consumption.
Yeah, I think it'll dampen consumption. The key here is that corporates are under a bit of cash flow pressure. Their margins are being squeezed a little bit. If you look at one of the charts, I'm going to show. I'll dig out for our call on Thursday. Is short-term liquid assets as a share of liquid liabilities, and they've fallen quite sharply because assets are going down, liabilities are going up. And interestingly, the reason why liabilities are going up is because trade payables have gone up very sharply. So companies are starting to struggle to pay their bills, which means it just tells you they've got a little bit less cash around, which is consistent with this idea that money's being money supply is shrinking now. So there's less money around. Cash flows tightening up. Companies don't want to do any capex. You see those surveys asking them, well, is now a good time to expand? They're all saying no. So, companies, I think, are going to start to cut back. They've already started drawing inventory. Capex, I think, is starting to turn lower, and they're going to eventually they'll cut some jobs, which is why it's so interesting to see job openings falling. And we're going to get an update on job openings later this week. That will be quite interesting because the labour market is just starting to deteriorate at the margin.
Thank you very much, Harry.
Stefan, thanks a lot. See you Thursday.
Yeah, see you Thursday.
Okay, thanks. Okay,
take care. Bye.
Bye.